Okay. But I think some other students also struggle with this question, so it's
Yeah.
easier if I record it. Am I sharing the screen with you right now?
Yeah.
Okay.
Could you like scroll to the top, I think? Because that's where I want to start.
The top.
Yeah, like the first question.
Um, did you? Oh, you are so question 4. Did you say the last question?
Yeah, question 4, but like see how it says requirements A, B, C, and D.
A, B, C, and D.
So I think it says
Yes.
requirements
Yeah,
C.
we are going to do the. Okay, let me see. Oh, here. Okay.
Yeah.
All right.
Okay,
Oh,
so I was, on page 166, there's that chart thing. Exhibit 4-17. I forget what it's called. Let me check.
is this? Are you talking about textbook?
Yeah,
Okay.
that's what I was like kind of referring to. I think you used it in your slides too, actually. Um,
Do you want me to go through this question with you?
yeah.
Okay.
Well, I did like the chart, like I followed that chart. It used the cost to cost approach
Yeah.
to find its like gross profit and its revenue and stuff to enter the numbers.
Okay.
And I just want to know where like my numbers came out wrong from yours. Because I see you have like 700. I think it's just you say like enter all amounts in thousands.
Maybe no. Maybe your number is different from mine.
No, I have the same numbers.
Same
I
numbers.
think,
Yeah. So
yeah,
I'm going
go
to
down.
explain to you all
Okay,
these
yeah,
numbers, how we get these numbers. Okay.
yeah,
Yeah, that's what I'm going to do. Yeah. Okay. So let's take a look. So, are you able to read the
yeah,
question? Okay.
yeah,
So the optimistic LTD is constructing a residential high-rise in downtown Vancouver for a contract price of 12 million. So this is a fixed price contract, right? So
yeah,
that's for 12 million. That's the price. Cost for this contract were initially estimated to be 9 million. Okay, that's the initial estimation, $9 million for the cost. The company uses the percentage of completion method of revenue recognition. Okay, and then they use the cost method of estimating the percentage complete, right? The following information is available. Let's take a look. Okay, so let me make this bigger. You see it's bigger?
yeah. I could see the numbers.
Okay, you can see it now, right?
Yeah,
Okay, so uh, so 3 years project, year 1, 2, 3. Each year, so this is the cost incurred in each year. So 3,500, 65, 2,000 additional cost complete, billings on the construction in progress, cash collected, right?
uh-huh.
Okay, so this is the basic questions. So let's figure out what is the gross profit, right, for the first year, right? For the first year, first of all, let's use the percentage of completion. We are using cost to cost method, right? So
Yeah,
in first year, you use the cost incurred to date, which is the cost in the first year, right? That's this number,
yeah,
3,500, right? And you estimate the additional cost to complete at the year end is 6,500, right? That's the additional cost to complete this project.
yeah,
The total cost estimation, that's the numbers together, right? So you add the number together, you should have, I think it's 10,000, right? 35 plus 65, right?
yeah.
Now,
Oh,
what? Go ahead.
oh yeah, no, I'm listening. You could keep going.
Okay. So your total cost is maybe no, it's 10 million, right? 10 million. Yeah.
Yeah, 10 million.
Okay. So now, what is your price? Your price is 12 million, right? Right.
Yeah,
So your total expected gross profit, total expected is 12 million minus 10 million is 2 million, right?
Uh-huh.
Okay, and then what's the percentage of the completion? Okay, let me see. Where should I? The percentage of completion, okay, should be cost incurred to date, which is 3.5 million divided by total expected cost, 10 million. That's going to be 35%, right?
Uh-huh.
So the total expected gross profit is 2 million, right? So your total expected here is 2 million. Do you see here?
Yeah.
And what about 35% of that? So 35% times 2 million, that is 700,000. Does that make sense?
Yeah.
Okay. So that is the 700,000. Did you see here? 700,000.
Yeah, I got 700 for the first year.
Awesome. Good
I
job.
put- Yeah.
Now
Was
let's take a
that
look
adding
at,
it
let's take
wrong?
a,
Adding too much zeros at the end? Like instead of just putting 700, I put 700,000.
oh, let me
I
show
think
you
that's,
why. Just
yeah.
give me 1 second.
I think that's
Did
why.
you see here?
Yeah,
This
that's why I was confused.
yeah, here, did you see enter all amounts in thousands? So
Yeah, so
make
that's why I
sure
didn't.
you read your a lesson you learn. Make sure you don't do it again in the midterm.
Yeah.
The lesson you learn is you want to make sure you read the question very carefully, right? The
Because
question is
yeah.
clear that you enter all amounts in thousands, right?
So yeah, so since it was 700,000, I just put in 700.
Yeah. So
Okay.
yeah, it should you
Okay.
should enter all amounts in thousands. So you should enter 700 here
Okay.
because
Yeah.
it's in terms
That's
of
all.
thousands, right?
Okay.
Okay, year two. Let's take a look at year two. Okay, year two. Okay, so again, I need to make this bigger. Oh, okay, is that big enough? Okay,
Yeah.
good.
Okay.
Okay, so for year two, right? Year two, um, so the first question is, what is the cumulative cost for year two? Okay, you want to know cumulative cumulated cumulative cost up to the end of year two, up to end of year two, right? So
Yeah.
the answer is the total of year one, year two, right? You're gonna use you are going to use here. Okay, this is what happened. What's the actual cost in year one, and this is the actual cost in year two. Okay, together you add them together. This should be your total cost incurred to date at the end of year two. Okay, so that's gonna be okay. So let's see here. So this is going to be 100,000. Sorry, 10 million, right?
Yeah.
What's the total cost, right? What's the total cost? The total cost, okay. Total cost. That's so note that there's additional cost to complete 3 million, right? So you already incurred 10 million, and you need additional 3 millions to complete. So the total cost estimate is 30 million, right?
Yeah.
And the contract cost, the contract price is 12 million, right? So now you realize now this is the onerous contract, right? Now you realize this is the onerous contract. Oops. Onerous
Okay.
contract. And the total expected loss, that's gonna be 1 million, right? You're gonna have a $1 million loss. Is that right?
Yeah.
Okay, very good. So here, if you take a look at here, in year two, okay, give me 1 second. In year 2, you have to recognize 100% of loss because it's a onerous contract. IFRS require us to recognize 100% of the loss, right? Remember that?
Okay, yeah.
So the minute you realize this is the owner's contract,
Then it's
at this
100%.
point, you have to recognize the full amount of loss
Yeah.
of this contract, right? So 100% of the loss is 1,000, right? So up to the end of second year, you should recognize in total $1 million loss. However, in the first year, you recognize the profit, 700,000. You have to reverse it, right? Because you know better now, there's no profit on this contract. Whatever the profit you recognized in previously have to be reversed, right?
Yeah.
So then you reverse that 700,000. So in total, in the year 2, you have to recognize $1.7 million loss, right?
Yeah. Okay.
Together, the first year you have a revenue of 700,000, and the second year you have a $1.7 million loss. Together, you have a $1 million loss, right? That's this one. Okay?
Okay.
Does that make sense?
Yeah.
Okay, awesome. So let's take a look at year 3. Let's take a look at year 3. Okay, so I'm gonna do this again. Okay, is that good?
Yeah.
Okay, so at the end of year 3, what is my total, what's my cost incurred date to the end of year 3, right? What is that? So I'm just gonna add up the actual cost happened in the 3 years, right?
Yeah.
You have 3.5 million plus
So you get
6.5 million plus 2 million, right?
Yeah.
That equals 12 million.
Yeah.
So this total cost is 12 million and exactly equal to the price. The price is also 12 million. So now this is not the onerous contract. So what's the profit? That's 0. No profit, right?
Yeah.
Because the price equals the total cost, right? But it's not an owner's contract, okay? Okay, so now keep that in mind. Over 3 years, there is no profit, right? There's no profit. Okay, so here, let's take a look. Let's take a look at here. I'm gonna zoom this in. So this is the year 3, right? Year 3, this 100% means the project is 100% completed, right?
Yeah.
And what's your profit? 0, right?
Yeah.
So in total, you should recognize 0 profit, right?
Yeah.
Up to the previously, you recognize a loss of 1,000, right?
Yeah.
So now you have to reverse the loss because this is not the owner's contract. Now you know better at the end of the completion. It's not the owner's contract. There's no profit, there's no loss. So previously, right, at the end of year 2, you recognize $1,000 loss. This has to be reversed, right? So you're gonna recognize $1 million profit at the end of year 3. So now you have 700 in year 1, 1.7 million year 2 loss, and $1 million profit in year 3. If you add them up, what do you get? If you add these 3 numbers up together, what do you get?
You get 0.
0, right? That's the number we want, right? Because we know the total profit is 0, right?
Yeah.
Okay, do you have more questions on this?
No.
No? Good. That's good.
And then the revenue I got right, I just entered the numbers like wrong again. I put 12 million instead of 12,000, and
Oh,
I put,
I see. So
yeah,
basically here, this is a calculation of the percentage, right?
so that's the one I didn't get right. This 10,000 divided by 13,000. I think I pressed the other one. So why is it that one?
Because this is year two, right? They are asking you determine the formula, enter an amount to allocate the revenue, right?
Yeah.
So this time they are not asking about the gross profit, they're asking the revenue, right? So to be recognized on year two. On year two, cost incurred to date is 100,000. Sorry, is 10 million, right?
Yeah.
And the total expected cost is 13 million. So 10 divided by 13, that's the percentage of the completion.
Okay.
Yeah. And
Yeah.
then your total revenue is 12 million.
Yeah.
So when you multiply your total revenue against the percentage completion, that's how much revenue you should have recognized up to this point. Okay.
Yeah.
Okay. So in the first year, they recognized, if I remember, first year is 35%, right?
Yeah, it is.
Percentage. Okay. 35% times 12 million,
Is
that
30.
is
Yeah.
4.2 million. Okay.
Yeah.
So in the first year, they recognize 4.2 million. Okay.
Okay.
So, and then we know by the end of year two, we have to recognize in total this amount of revenue. Okay. And I know year one, I recognize this. The difference is what I need to recognize in year two. Okay.
Yeah.
All right. Is that clear?
Yeah. Yeah.
Awesome. So let's move on. Year two, journal entry. Okay. Um, the cost is year two's cost is 6.5 million, right?
Yeah.
So you debit construction in progress for 6.5 million. You credit cash for 6.5 million. Okay.
Yeah.
And billings, billings on construction in progress, 4 million, right? So for billings, you are going to debit accounts receivable for 4 million. You credit um, billings on construction in progress for 4 million, right?
Yeah.
We know this. And collection, cash collected, 4.2 million. So you debit cash for 4.2 million. You credit accounts receivable for 4.2 million. So these three entries should be quite straightforward, right? It's not too hard on
Yeah.
this.
Yeah. I was just getting the number entries wrong because I
Okay.
was putting millions.
Okay.
Yeah.
So now prepare the journal entry to recognize revenue expenses, right?
Yeah.
Revenue expenses. The year two, the cost of goods sold, that's equals to the actual cost, 6.5 million, right?
Yeah.
And you recognize the gross profit, okay? Uh, remember, you have to reverse the gross profit, 700,000 from the year one. Remember that? You have to
Oh,
reverse this entry, yeah? You
yeah.
credit construction in progress for 700,000,
Okay.
and the revenue recognized this year, which you just calculated, right? It's
Yeah.
5.031
Yeah.
million. Okay. And the difference is the provision for owner's contract. The difference is your loss, right? Is
Oh,
your loss for the percentage of the completed to date, right? The total loss is 1 million. The percentage of completion is 76.9. Okay. Therefore, you have a $769,000 loss. Okay.
yeah.
So this basically this number. Okay, I want to show you here. If you calculate this percentage, this one should be 76.9%, right?
Yeah.
Okay. And the total loss
So,
is actually 1 million, right?
yeah.
So the percentage completed is 76.9%. So that's times 1 million, you get $769,000 loss to be recognized. And the difference is 231,000, which is the expected loss in the year 3. You debit expected loss for the year 3, 231,000. You credit the provisions for onerous contract, 233. Sorry, 231. In total, this entry provisions for this entry provisions for onerous contract, and these two together in total should be $1 million. Okay.
Yeah.
So does that make sense? Let me just show you a little bit better. Okay, this is what I'm saying. So you have a provision for the onerous contract, right?
Yeah.
So this number 769 and this number is 231. Together, these two numbers together should equal the total provision, total liability, which is your total loss, 1 million.
Yeah.
Sorry. So that should be your here should be your $1 million loss in total. Okay. That's why there are provisions. Provisions means liability, right? So you are not making any money. If this contract becomes your liability, right? You can't get out of it. And you're gonna have a cash outflow. You're gonna lose money. So that becomes a liability. Provision is a term for liability under IFRS. Okay.
Okay.
Yeah. So does that make sense?
Yeah.
Yeah. Okay.
Yeah.
So is this everything or is there more?
I think there's one more.
Okay. And then year 3, you have to close these two accounts, the inventory and unearned revenue account, because you transfer the asset to the client and all the revenues become earned, right?
Yeah.
You debit this unearned revenue for 12 million and you credit your inventory assets, right? Construction in progress for 12 million. That's this question. Does that make sense?
Yeah, now it makes more sense. Thank you.
Okay. Yeah, it's important you know this kind of questions. It's really, really important, right?
Yeah.
Yeah, understand how to deal with the onerous contract. Yeah.
Okay. Yeah. I think that's all. Wait, on question 3.
Yes.
I got the May journal entry like all correct. And then August, September, October, November. You know how you only enter one?
Yeah.
I was just confused on like why there was only one entry for a month, like per month, instead of 2, like a debit and
No, I think this is maybe a problem with the Pearson website.
Okay, because I was so confused. I was like, there's only one entry for August. And
no, you can't, right? You need at least have 2.
Yeah, that's what I was wondering.
Yeah, because this is all we are doing is double entry, right? Accounting.
Yeah.
We do debit credit. So it's important. It's impossible to have one line to finish
Yeah,
to
that's what I was wondering.
record.
Okay. So that was just
yeah. So in this case, do you have the same number or maybe it's a different number?
For May, I believe I had. Let me check real quick. I believe I have the same number. Do you have 100,000, 65,000, and 35,000 for May? Okay,
yeah.
then
So for May, basically this is the installment purchase, right?
Yeah.
So they are deferring the recognition of the revenue, I believe, right? They only recognize revenue to be equal to the amount of installment paid, right?
Yeah.
I mentioned this during the class. So in May, when they first have this transaction, so what happened is right away they have a receivable, right? So they are collecting the money, right? They have this installment accounts receivable for 100,000, right? And the items has been shipped to the customer. So your inventory level goes down, right? Your inventory level goes down. You credit your inventory, for 65,000, right?
Yeah.
And the difference, of course, is the money you make, right?
Yeah.
But you do not recognize this as a revenue, right? Remember,
Yeah.
you defer this into the future. So this is called deferred gross profit, 35,000. And then what happened is you received a cash of 25,000, right? This is probably their first installment made, 25,000, right?
Yeah.
So then you receive cash, you debit cash for 25,000, okay? And your accounts receivable should decrease by the same amount. Is that right?
Oh, okay. Yeah.
Right? Because you are collecting AR, right? You convert AR into cash, right?
Yeah.
So whenever you do a cash collection, your AR decreased, right? Your cash increased. So that's this entry. You debit cash for 25,000, and you credit installment accounts receivable for 25,000, right?
Yeah.
And remember, they recognize revenue to be equal to the amount of installment they received, right? So that's why they received the installment payment 25,000, and they recognize the sales revenue for 25,000, right? So they credit a revenue for 25,000, right? And then 65% of this are cost of goods sold, right?
Yeah.
Right? 65% is the cost of goods sold because the profit margin is only 35%, right? You can see the sales is 100,000,
Yeah.
the profit is 35,000. So the gross profit is 35%, right?
Yeah.
And the cost is 65%, okay?
Okay.
So the sales revenue is 25,000.
Yeah.
So 65% of this should be the cost of goods sold, right?
Yeah.
That's the 16,250. And the remainder is 8,750. That's your realized gross profit, right?
Yeah.
So when you realize the gross profit, you're gonna reduce this. You're gonna reduce this, right? So this is kind of like an unearned revenue, right?
Yeah.
So when you earn the revenue, you're gonna do the opposite. You're gonna debit deferred gross profit, right?
Okay.
So over the time, you're gonna make this to be a gross profit, right? Instead of deferred gross profit. Over the time, you're gonna debit in total 35,000. For this installment payment, you debit 8,750. That's
Okay.
This number is 35% of the installment sales revenue.
Okay. All right. Yeah, no, that makes sense now. I was
Yeah.
just confused with the whole month thing on the side.
Yeah. So first of all, you can try see if you can change the date. Second of all, just use some of your judgment, saying it
Yeah.
can
Yeah.
be only one
Yeah.
line, right?
Yeah,
You
that's what
cannot
I
finish this in one line, right?
Yeah. Okay. I think that's all my questions.
How about question 2 and question 1?
Question 1 I was good with. Question 2, that was kind of like the cell phone example you did, right? Actually, yeah, quickly go to question 2.
Yeah.
So I was confused on why it was 33.33. I thought it was $50 per month.
Oh, because the term is different, right?
Oh, okay.
Because the first option A is a 3-year contract, right?
Yeah.
And option B is a 1-year contract, right?
Yeah.
So if you average per month, okay, so 1,200 in total, and over 3-year contract, that's 36 months, right?
Yeah.
So if you use 1,200 divided by 36 months, so each month is 33.33. Yeah.
Oh, okay. Um,
Right?
how come
Because
it
you are
says,
saying the total cost for cellular service is 1,200, right?
yeah.
So
Well,
you're gonna,
I put 0 for the immediate phone recognition for option A because I didn't know it was 600
oh
right
no,
there.
you can't put 0, right?
And then I put
If you
18.
take a look at option C, right?
Yeah. Oh, yeah. Okay. Yeah. Because then, yeah, I got
So
option C right. So I was like, oh.
there's a cost for the iPhone, right? You have to
Yeah.
allocate the standalone selling price, right?
Yeah.
So the option one, so the phone has to get 600 because that's the phone's standalone selling price.
Okay. Okay, now I get it. Now I get it then.
Yeah.
Yeah. Because yeah, I got my totals right
Yeah.
and
Your total should be 1800,
yeah.
right?
Yeah.
You have to give first. You gave 600 to the phone because you know that is the standalone selling price, right?
Mm-hmm.
And
Okay.
you don't know the cellular service standalone selling price, and so you use residual approach, right? So you
Yeah.
take the difference,
Yeah.
then you allocate the residual 1200 to the cellular service,
And
and
then
then
you
you
divide.
divide it by 36 months
Yeah.
because
Okay.
option A is a 33-year contract,
Yeah.
right? So then it ended up around 33.33 per month.
So then for option B, even though it says it's purchased at 400 for a 1-year contract for $50 per month, it's 600 for the immediate recognition.
Yeah.
And
then whatever left is 400 for the cellular
yeah,
service, and
the
this is
diff
a 1-year
okay.
contract.
So they just
So
divide that by
divided by 12, right? Divided
yeah.
by 12, yeah.
Okay. Okay, then yeah. Yeah, then that's everything.
Okay, awesome. I hope it helps. It makes sense.
Yeah, it
And
did.
yeah,
A lot more clear.
yeah, and happy Thanksgiving.
Yeah, thank you too.
No problem.
See
Okay,
you.
have a nice day. Huh? Yeah,
Yeah.
bye.
Bye.